Good morning. It is Monday, June 30th, 2025. I am Herb Morgan, Senior Managing Director here at Cantor Fitzgerald Investment Advisors. This is my weekly economic and market commentary. You can find comments intra-week, should they happen, on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. This presentation is designed for you. Doesn't matter if you are an investor or an investment advisor or anybody else. You are still expected to make your own investment decisions. Nothing contained in the presentation should be treated as investment advice, tax advice, recommendation for the purchase or sale of any security, etc. It is all for informational purposes. The views expressed herein are mine and mine alone. They do not necessarily reflect the view of anybody else at CFIA, its parent company, its affiliates, or other portfolio managers here at the firm. Taking a look, we had a big rally in equities last week. S&P advanced almost 3.5%. Mid-cap stocks participated. Small cap participated. International, emerging markets, everybody participated. Everything into the black now for the year. The S&P now mid-single digits. Here we are, halfway through the year, 5.5%. Simplistic math says, if that were to be extrapolated, 11-12% by the end of the year, what a great year that would be. We know anything could happen. Fixed income markets positive also for the year across the board, right? If we were getting ready to enter a recession or something like that, I don't think you'd see a positive return on high yield. You'd see the spreads between high yield and treasuries start to widen, and we probably wouldn't see that positive return. And then alternative investments doing well as well halfway through the year. The investments that attempt to be non-correlated to stocks and bonds. Let's get into economic data last week because it really was much better than expected. And if you remember last week, I made this call. I think the Fed's going to cut for the first time at the end of July rather than at the end of September. I said that despite knowing, well that the Jackson Hole meeting will be in August. The political pressure is definitely there, and now the markets are starting to discount that possibility as well. However, the inflation data wasn't great last week, so now I'd put it back into play that we get pushed out to September. But let's get into that economic data. Let's start with the U.S. Manufacturing PMI Purchasing Managers Index from S&P Global, unchanged at 52, but above the estimate. That's 2 consecutive months of 52. Remember, manufacturing is about 15% of the U.S. economy. It has been lagging, but if you look at the graph here, 2 months in a row above 50, solidly above 50, I should say, bodes well for manufacturing. Services, another good reading there in the month of June, 53.1. That was down a little bit from 53.7, but a solid across the board reading. The sector or the industry that is not doing well and has not been doing well for some time is residential real estate. It makes up about 4%, so it's a big piece of the U.S. economy. Let's start with existing home sales. They were up 0.8%, beating the estimate of down, but remained down on a year-over-year basis. The annualized pace of existing home sales is at 4 million. This was 6.5 million back when we had the ultra-low, artificially low interest rates created when the Fed cut rates to zero in response to the COVID pandemic and the pandemic. FHFA House Price Index fell in April, so home prices are declining, although very modestly, but they are still up on a year-over-year basis. According to this metric, they are up 3% on a year-over-year basis. It's pretty rare that you get down months in the FHFA Housing Price Index. There's two back-to-back, and now here's one here. That's not many over the last 5 years. Actually, this chart shows 10 years. You don't get many down months in the FHFA House Price Index. Same thing with the Case-Shiller Home Price Index. This was the second month. Case-Shiller says home prices fell. FHFA, the difference between the two, FHFA is those homes that are sold to buyers using mortgages through some of the government-sponsored enterprises or GSEs. Case-Shiller is a broader index, so it's going to include the bigger ticket items that are not eligible for those assistance programs, the bigger ticket priced homes. So here again, you don't get a lot of down months, but second month in a row This time you can see over there on the far right for the Case-Shiller Home Price Index, still higher on a year-over-year basis, 3.4%, a little bit below the estimate of 3.9. New home sales continue to also be poor, low. We need 1.2 million new homes per year in the United States to be built just for population growth and replacement of dilapidated inventory of homes. But new home sales, the annualized pace dropped by 0.7% in May after a big pickup in April. The annualized pace is 623,000. That is about half of what is needed. Pending home sales, not looking particularly better. They did rise 1.8%, so that was great, but they're down on a 0.3 year-over-year basis. Residential real estate continues to be unaffordable, particularly in places like California. Interest rates being a big component of the affordability. One of the reasons I think the president's trying to pressure the Fed to cut rates is A, the U.S. government's borrowing costs, but B, homeowners' borrowing costs. I still think the Fed is doing the right thing in focusing on inflation and waiting for those numbers to get better and standing pat on their position that their dual mandate, what their dual mandate is, price stability and full employment. We have full employment, so they are focused on price stability. Cutting rates, to me, would not make sense at this time, although I still think they might at the end of July, and they will by no later than September. The Conference Board's reading of consumer confidence fell to 93. The estimate was 99.8 or 100. So we're down here, and people aren't feeling particularly good. It has a lot to do with the price of goods, inflation, cost of living, eggs, milk, food, energy, auto insurance, homeowners insurance, airline fares, gasoline, you name it. All of that is what's factoring in here. We are now getting a rally in equity prices as we expect the passage, perhaps by July 4th, of the one big beautiful bill, the pro-growth stimulative tax cuts. So you can expect consumer confidence to get a little better for those people that own equities as they see their 401k and other balances go higher. Weekly claims for unemployment came in at 236, so down 10,000 from the prior week. We still have this upward trend in place. You can see the red line, the 4-week moving average, continuing to move higher. Though it was a down week, continuing claims rose again to 1.974, yet to cross that psychologically relevant, 2 million mark, but maybe soon. The other soft news, which lends me to believe the Fed's getting closer to cutting, last week, that the GDP, which originally had been reported in the first quarter as minus 0.2%. You say, okay, well, that was negative. That's bad. Well, a lot of that came from a big surge in imports, which are a subtraction from GDP. It was a roll-off after the Q4 surge when the incumbent president usually tries to get the spending out the door to boost the economy in Q3 and Q4. So I wasn't concerned at all and didn't think the economy was softening at all. However, personal consumption, in this revision that we got last week, personal consumption was revised down from 1.2 to 0.5. That's pretty significant. Services spending, remember, services are 85% of the U.S. economy, also revised down and significantly, cut by almost 2/3, 1.7 to 0.6. Goods spending unchanged. It is now clear that it was more than just the surge in imports to get ahead of the tariffs, the small reduction in government spending related to the implementation of the Department of Government Efficiency, but consumers themselves, the most important component of our economy, pared back spending on recreational services, on travel, and that section did not turn negative, but it grew at the weakest level since the onset of the global pandemic. This is real data that the Fed will consider at its July meeting as it considers whether or not employment is on the line, because that is the second part of their mandate. As we look at the Fed funds futures, the potential for hikes and cuts and all that, as of this morning at 7:43, when I pulled this data from my Bloomberg terminal, for the July 30 meeting, it's live, right? They're saying there's a 20%, let's call it, chance of a cut. You can see that here. But the futures are pricing in for sure 25 basis points lower by September 17th. It all comes down to what data we get in the next 30 days. The markets just keep coming higher, and the inflation data keeps being not that great. The punt to September allows them to get the Jackson Hole meeting in advance. But I still think this is more live than the market's realizing, and we could potentially get that cut in July. Moving on, durable goods orders for the month of May were up a whopping 16.4%, about almost double the expectations. Backing out the big transportation items, which you need to do, 0.5%, solid good orders for durable goods. Personal income fell 0.4% in May after a big gain in April. Personal income is 4.5% higher than it was a year ago. There was a pullback in government transfers, so that's probably seen as good given the perilous nature of the income statement of the United States Treasury. Personal spending down about 0.1%. Speaking of inflation data, personal consumption expenditures, or PCE, this is the gauge the Fed uses to determine whether or not it is obtaining its statutory mandate of price stability and their self-designed goal of 2% core PCE inflation. You can see really not trending lower any longer. I think some of the intra-meeting data suggests that it will. I showed you that last week where I showed you months rolling off of CPI in the fall. We're going to see that here with PCE as well. But we're still not down to that 2% level on core. We are at 2.7. That's significantly above the 2. So it's what the Fed has to consider when they consider whether or not they're going to cut rates at July or September. University of Michigan's consumer sentiment spiked a little bit this month in June, rose from 52.2 to 60.7, right in line with estimates. Current conditions rose, expectations rose as well. Some of this is, I think, related to the run-up in equity prices. I talked about that earlier. Some of this is just some relief in consumer prices. But let's keep this in perspective. This is not a good number. It's just better than the two really bad numbers. Good numbers are Michigan sentiment in the 100 level, which you see here. We're starting to get data now on tariff revenue since the implementation of U.S. tariffs and the negotiation of trade deals with different nations. Some of these are unilateral implementations of tariffs that may be reversed as trade deals are negotiated. But we do have data. And it's worth noting, obviously the president took office at the end of January. You can see the U.S. average is around $7 billion a month in revenue related to import duties or tariffs. That started to grow by March just a little bit, and then April, and now May. So if we stop here and we don't get any more growth, we're still looking at $250 billion a year in tariff revenue. That is substantial. So now we need to start talking about, okay, well, how much of that is going to be reflected in prices? How much will be inflationary or won't be inflationary? We know that debate is certainly ongoing. And we know the core PCE inflation index, which I just showed you, is still stubbornly above the Fed's target. But we do need to report on this. This is real and significant revenue related to tariff implementation. The other big thing that's happening that's going to affect all of us in our pocketbooks and our portfolios and our budgets is the one big beautiful bill, and that is literally the name of it, which I find funny. Current status: the House passed a version of the one big beautiful bill. They advanced it to the Senate. The Senate a couple of days ago voted 51-49, so right on that party line, to begin debate. They're now in what they call a vote-a-rama. And the GOP, the Grand Old Party, the Republican Party, is aiming for final passage of the bill by July 4th. We don't know if that will happen. It's symbolic. Obviously, Independence Day holiday. Some things that are in that we know are in that are not really being debated right now. Number one, the extension of the 2017 Trump tax cuts. That's those highest marginal rates, the corporate rates, the SALT deduction cap. There's going to be an increase in that cap. Whether or not it'll be 40,000 or not, we don't know. There's a significant amount of Medicaid reform, tightening eligibility requirements and work requirements. It's a big contributor to the federal deficit, which leads to the accumulated federal debt, rolling back some of the incentives for electric vehicles, and increasing some funding for both Border Patrol and national defense. Some things that are out, you can see on the right. None of those are particularly significant from an economic and portfolio perspective. And then what's still on the fence, as I mentioned, the final SALT amount, Medicaid rules, how much of this clean energy rollback will take place. And then I think the biggest one of all is they want to increase the debt ceiling yet again, another $4 to $5 trillion. And I think the real fiscal hawks are fighting and pushing back on that, wanting more spending cuts and more government efficiency. Today, Monday, we got the Chicago PMI. Tomorrow, manufacturing PMIs from S&P Global and ISM, construction spending, job openings or JOLTS, vehicle sales from Wards. And because of the 4th of July holiday falling on a Friday, we're going to pull the jobs reports forward. ADP will be on Wednesday, expected to add 110. Thursday, we will get both initial claims and the unemployment, the non-farm payrolls expected on add 120,000. Trade deficit at 69 billion. Now we got to wait for the shrinking of the trade deficit, which contributes to GDP. S&P Global and ISM services on Thursday, along with factory orders. Friday is the 4th of July. I hope you all have a very good one. Barbecue, celebrate the independence and the founding of our great nation. This is available on all podcast formats. The best place to get this is YouTube, where you get all the charts and graphs. Thanks, everybody. I will see you again in 1 week.